Once upon a time, in a land not so far, far away, there was a man named Ryan. He sucked at accounting. He didn't know the difference between a restrictive endorsement and a blank endorsement. Ryan, even though he was an accountant, he continually wrote dishonored checks from the business accounts. He didn't know the difference between liabilities and assets and couldn't even tell you what owner's equity was and how it related to a T account. He spent in surplus using his credit card, which gave him bad credit. He was always using his petty cash and never refilled it at the end of the month. He was always making adjustments in his journals, never posting the right amounts. This moron of an accountant always puts the wrong amounts on his income statements and never used the right source documents. He always mixed up his memorandums and his receipts.
His expenses were much greater than his revenue, which resulted in a net loss instead of net income. Much unlike Ryan, there was another accountant in his law firm who was especially good at preparing financial statements. His business ethics were on point when he prepared a bank statement because he knew the accounting cycle very well, all the way from analyzing transaction to proposing post-closing trial balances, always carried forward and brought forward, and could always prove cash. He was extremely nice to his co-workers, making sure ethics and code of conduct came before work. Is that good?
At the end of the day, the good accountant made a lot of money and used an electric funds transfer to get into his bank account. Ryan, on the other hand, had barely enough money in his checking account to make a withdrawal.